Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
G'day everyone, thanks for joining us, Investing Insights. I really enjoy this podcast. We do it every single month in partnership with our good friends at the Right Property Group, Steve Waters and Victor Kumar. We're now in our second series of this, so obviously it's working, and we do appreciate the feedback that's been coming through. Very different to the Smart Property Investment Show, if that's how you found us right now. Smart Property Investment is really talking with investors about how they're going about doing stuff. The Investing Insights podcast we do with the Right Property Group allows us to deep dive into a lot of the complexities of property investment that we typically don't touch. But, you know, I'm not qualified to do it myself, and I have some very good co-hosts in terms of Steve and Victor who live and breathe property as property strategists through the Right Property Group. And today in the studio, I only have one of them, Steve Waters. Victor, from what I understand, is swanning around in sunny Fiji.
Living the life.
Probably drinking some kava. He loves it.
No comment.
No comment at all. Well, how long's he over there for?
Just a week, I believe. He's back on Monday. He's over there for a family wedding.
Okay, well, there you go. Oh, well, yeah, we miss you, Victor. It's not going to be the same without you, and your views and observations, interpretation of all the crazy stuff going on with the property markets is something that I lean on myself. So we'll get you back in the studio for next month. But today, mate, it's just me and you.
Just me and you.
What do you reckon? How's things? What's going on in the world of property at the moment?
There's a lot of changes, which we expected, but I think there's also a lot of negative media around at the moment. You would have been living under a rock if you haven't seen it. And I think that that's starting to perpetuate the market in a different direction. But for me, I think it's just normality. I think more to the point we're coming back to normality as opposed to the great bull run that we've had, especially in the Melbourne and Sydney markets.
Yeah. So last time we got together, Steve, and go and check it out, 22nd of June was the last instalment of Investing Insights with the Right Property Group. And what we did, we went through, by memory, a whole bunch of different investment strategies and what actually works. And our conclusion was that there's lots of good strategies out there. The fact is that you need to select the strategy that's right with you, that's going to help you achieve your property investment goals now and into the future. I follow a particular strategy, you follow a particular strategy. Our strategies aren't that dissimilar, and it works for us. The strategies that we pursue in terms of buying under market value properties in affordable areas with high propensity or indicators for growth, which are as cheap as possible to hold. That's a strategy when you look at this current market, which should hold us in pretty good stead, because the top end of town, your sort of, let's call them blue chip properties, $1 million plus that investors are investing in, it's quite hard to get financing on these things right now. So, I think the price pressure and also the pressure around yields at the sort of more affordable belt will probably carry us a little bit better during this, let's call it a softening of the market. I'm not going to call it a property downturn, because the only place where really properties are going down in value is Sydney and in Melbourne, right? There's other parts of Melbourne, and parts of Melbourne. So I want to big it up. And to your point, be careful where you get your media from. Be careful where you get your information from when you're making property investment decisions, because the media is notorious for sensationalising stuff. So people want to read it, and they want people to read their stories or buy their newspapers. So
I think it's I think you make a really, really good point, and that there is probably hundreds of strategies out there that work, and there's probably an equal amount that don't. And we have very similar strategies, but the reason we use our strategy is because of this very moment in time. And once again, it's not the only strategy, but it allows us to sleep at night, as we often talk about.
Yeah.
And as we've often talked about as well, you shouldn't be judging a property and its worth and its potential in a good market like we've just experienced, but how it's going to perform to you or for you in a not so good market, so a bad market, because that's when the rubber hits the road. That's when your capacity to be able to control and keep the property is paramount. That's survive or not.
It is. And so as a property strategist, and I think we're fortunate in Australia that the buyers advocacy, buyers agency, property strategist industry is growing quite considerably. So more and more Australians are turning to professionals like yourself to secure investment property or even own occupied stuff. You guys don't do own occupied stuff, right? You're primarily just property investors, but a lot of people use property buyers for that as well. So I think we're fortunate that we have this emerging industry, and people are being a lot more astute in how they're purchasing property. Like, how many people go out and make their own investment decisions around stocks or other asset classes versus property. I say, a lot more people secure advice on the other stuff rather than property. So we're seeing a lot more of Australians going down this path, and I think that's very good, and we are a big advocate for it.
I think if I go back when I first started, I don't know, 15 years, maybe more ago, as a buyer's advocate and strategist, there was literally only maybe 5 or 6 of us.
There wasn't many, right?
Wasn't many at all. And if we fast forward to today, there's probably thousands.
There's a lot, and I'm trying to get numbers on it because I don't know. I'd like to help map and benchmark it, but my view would be not all property strategists or buyers advocates are created equal. But I'm not going to go into that today. What I want to have a chat about is that, in the community that we operate within property and dealing with a lot of property strategists and talking about strategy and talking about this changing market, a lot of strategists who have traditionally looked to offer advice around securing blue chip properties are having to rethink many ways how they go about delivering these services to their customers, because in many cases their customers can't secure the financing to be investing at that level, and they're having to come down a rung or so to look at this sort of $400,000-$500,000 mark. Is that a fair assessment? Is that happening? And the reason why they can't get that financing because they're getting serviceability assessed at 7+%, and all these other the rigor of bank policy changes that has changed the way in which they can focus on investing. They might make great income, but they can't afford to buy investment properties at that top end. Is that
very true?
Is that happening?
True. Yeah. So it and once again, not belittling any of the other strategies out there, and this is just our particular strategy. But what we're starting to see now is exactly what you just talked about, is that perhaps some of the strategies that are around that high-priced property with a much lower, let's call it a 3% or thereabouts 4% yield, combined with the fact that if they've owned them for 5 years and they're rolling off interest only into a P&I rate and they can't go elsewhere, so they're going to just have to wear that, that's having a massive effect on the household budget. And even if they're in a position where they want to buy again, or if they're a first-time buyer looking for the higher valued asset, the banks, as you say, they're just so tight now, and rightly so, with whatever the price asset is. But what we're seeing now is that some of those strategists are having to perhaps rethink a lot, and come into perhaps some of the more affordable corridors. And only yesterday I was in Brisbane for a couple of days, and going around with some of our buyers agents just for some ongoing training and what have you, and for me also to keep my finger on the pulse on the street.
The ground truth,
as we often talk about. And we were having I was having a chat with one of the agents up there as we were going through a few of the properties, and he was saying that there's a few other buyers agents that were also interested in this particular property. In fact, one of them had made an offer, and the company that was there making that other offer all before us was a company that usually plays in that sort of $700,000 to $1 million bracket. They're clearly having problems sourcing the finance for that top end price bracket, so they're having to come down into that lower price bracket. And when I say lower, without any malice.
I want to give some context on that, because we're talking about affordable areas. It sounds like it's, I don't know if I'm allowed to swear on this podcast, like the shit properties. They're not, right? We're talking. If you're talking about investing in mortgage belts of Sydney and Melbourne, I think of Sydney, for example, a fifth of all Australia lives in the western southwest suburbs of Sydney, right? It's where most of Australia lives, right? So we talk about affordability. No. That's the normal part of Australia. That's where most people buy their properties.
And this is where people, I think, when we talk about affordable corridors, is people do think that it's perhaps the low end of town. And that there's all sorts of dramas and problems with tenants and so on. But it is not the case. And if you look at these affordable corridors, they have the best infrastructure. And they've had it for a long, long time, because that is where the majority of people live. After all, that's the mortgage belt.
It's funny, and I think about this a lot, and I'm fortunate, I think, that I can actually put a foot in both camps of affordable world and the not so affordable world. I grew up in Blacktown, right? I know the western suburbs of Sydney very well. I delivered pizzas out there for 4 years, right? I know that part of Australia, I know it well. You have a lot of people that invest in property, typically are higher income earners. And if they're higher income earners, they typically live maybe in the more blue chip parts of Australia. So I live in a blue chip part of Sydney right now. It's a very blue chip part of Sydney, which is cool, right? So I get to see both sides. And my peer group, who typically are reasonable or high income earners, their view of affordable properties is really interesting because typically they'd be the people chasing these $700 million stuff, but now they're struggling to actually get the financing that. So they're starting to change their mindset around what is an affordable property and what is a good asset. And a lot of them are thinking about, oh, hang on a second, the suburbs of Brisbane, the suburbs of Melbourne, the suburbs of Sydney. Less so Sydney at the moment because I'm not investing out there. I don't think there's a lot of people out there. But you're seeing this paradigm mind shift now of people are starting to evolve their strategy. And it's it's a really interesting, I like the psychology of it. I find it really entertaining.
Yeah, we see it every cycle. And this is just history repeating itself, as we often talk about, because let's say those higher income earners who traditionally, well, generally speaking, they'll ride that higher priced properties growth. So, just round figures anyway, let's call it $1 million, 800,000, whatever. Yeah. And clearly 10% growth of 800,000 is better than 10% growth of 350,000 in terms of a dollar figure.
Yeah.
But when we throw what we call the netability into it, so let's take out all our negative shortfall, let's take out every cost associated with it, and let's look at it over not just a bull market that, if we're talking about Sydney, that we've had for the last 5 years or thereabouts, but let's look at that over 15 or 20 years, right down to a granular level, and then throw the something that you can't measure being a peaceful mind or a sleep at night factor, whatever you want to call it.
Yeah.
We start to see that this time of the cycle that a lot of people start to have that mind shift, and people that want to invest will invest. They'll always look for the opportunity, and they're starting to go to these more affordable areas. Now, once again, it's not the only strategy. It's just a strategy that we've employed and executed around our risk profile.
Yeah. So we spoke about these strategies last time we get together, and the nature of this podcast is really just interpreting that in a changing marketplace and how opportunities arise for investors in evolving marketplaces, whether up or down. And, I was just talking about the mindset of an investor to change the way in which they might view different asset classes. I'm talking about property, but asset classes being a unit in Bondi versus a unit on the train line out in Rouse Hill, or a house in Penrith. So if you have prejudices in that way, I'd say get rid of them pretty quickly because you're missing out on opportunities, particularly in changing markets.
Correct.
I'll put this to you, Steve. Often on Investing Insights or Right Property Group, we talk about the mistakes that people make in buying the wrong asset, and that stops them from investing or building a portfolio in the future. And often that asset might be an off-the-plan apartment that doesn't meet its valuation, and you get negative equity and you're hamstrung for 5-6 years until that thing comes up to where it should be. When you look at that same principle in an evolving finance landscape, so no one knows what's going to happen to mortgages moving forward. Maybe this 7+% serviceability metric at P&I, and banks are getting a lot more sophisticated now in how they map your
big data.
your spends, right? So you can't bullshit a loan document anymore because the bank knows exactly where you're spending your money. And
not that you ever should have, Phil.
No, not at all. And I never have. My personal P&L is squeaky clean, but it's getting harder, right? So this is the new norm. This is the new norm. So people who have traditionally bought their first investment property, which is higher end of town, 8 million plus, and the fact that banks now are so much tighter on serviceability, that might have them priced out of the market for 10 years now. Yeah. So it might be a great asset, but in terms of their ability to keep going on, it's not buying a dud off the plan apartment somewhere with negative equity. It's just that they cannot shift their earning capacity into gear to a point, or reduce their level of spending to actually show the bank that they are able to service new debt moving forward. So maybe this might be the new norm. I only buy one property,
Yeah, well, if you're at that higher end of the bracket, for sure. We often talk about I'd rather have three $300,000 assets than one $900,000 asset because that's my risk profile, and I love the cash flow.
Yeah, and by the way, I'm going to preface this by saying I have investments across both ends of town, right?
Yeah, as do I. And
it's million plus stuff, and I've got $300,000, $400,000 stuff.
And that's the reason why I'm so...
and I like a diversified portfolio, so it's great.
Yeah, and I'm the same, but that's the reason, once again, why we're in this, that strategy is ours, is because I've got it at both ends of town, so to speak. And the whole premise that the lower end properties or the more affordable properties give you more heartache and headaches than something that's worth $1 million. I can stand here and tell you that's just not the case. I have more troubles out of my higher valued assets when I throw everything into the pot, such as cash flow and headaches and repairs and maintenance, than I do in my more affordable properties. But that's just me. Maybe I'm just lucky that way. But I think, coming back to your point, I think with the changing in finance environment that we have, perhaps this is the new norm. And to be honest with you, I don't mind it. I really don't. I think as people, well, with the adventation of big data and the ability for banks to check and cross-check and share data, it's going to make people be a little bit more financially responsible.
And I think responsible. Well, people aren't being responsible for themselves, so I think it's a good thing that the banks are intervening in some ways because, there is a lot of, we talk about media and sensationalist media. There is this view now that every single person can be a property bazillionaire, right? Everyone has the right to own a property, etc. So a lot of these norms are changing, right? But still, people are still trying to keep up with the Joneses. And in many ways, that's precipitating a lot of poor financial decisions. So the education is out there. There's no excuse for not being educated in property or finance at the moment. Just listen to this show or some of the other very good property podcasts out there. There is so much free information out there right now that hopefully stop you making stupid finance decisions. That's my view, right? But it's not happening, right? No. So the banks and our government regulators have intervened rightfully to try and curb some of the less than sensible financial decisions that consumers are making. And big data is supporting this. So it's going to put the brakes on a lot of people, give them greater fiscal responsibility and make them more prudential through policy for what they're doing.
And they could go further.
That's good. They could go further.
They could go further. And once again, I wouldn't mind. But if they were really, really serious about being responsible, so to speak, then regulate us. Regulate the industry. That's going to have a huge effect.
It's not regulated. Property investment
is not regulated. No. So and you're on the board of people with me, and that's one of the things that we are always talking
for years.
Yeah, we want the industry to be regulated because that will give some sensibility and perhaps better operators within the industry. We want that.
Yeah, and I think the issue we have right now is a real climate of distrust in financial institutions and people involved in the financial sector. So we've gone through Royal Commission, and a lot of that's been highlighted. A lot of that's been sensationalised as well. It's been very, you can pick the worst out of everything and try and paint a picture that everything is fundamentally stuffed, right? But there is some people who are involved in the financial advice sector that don't necessarily always give the best advice for the customer. And there needs to be greater rigour, rules and regulation around policing financial advice in Australia, is my view.
I agree. And I actually think the majority of people would agree with that as well.
Yeah.
And if
people want to trust people, right? Fundamentally, people want to trust people. People want to get the advice that's right for them at any given time.
Yeah. So it's the bank's turn at the moment to be sort of raked over the coals. But as a prediction, and I look into my murky crystal ball, I think as the next 2-3 years unfold, we're going to see a little bit of distrust within the property industry as well as people. The values decline dramatically. And now when I say dramatically, I don't mean this free-falling brick. I mean that they paid too much to begin with, whether it be via slick salesmen, shiny brochures and off the plan or house and land packages, whatever it may be. So I think you're going to see a lot of hard luck stories over the next few years.
And the people with a vested interest will highlight these stories as the norm.
Correct.
That's what will happen.
They will.
And it always happens.
Well, it does. And it doesn't matter whatever the industry is, it always happens. Yeah. But once again, and I suppose making the point again, regulate the industry and we won't see this again, hopefully, or not as bad. Now, I'm not trying to paint this whole property economy, so to speak, as we're in all sorts of trouble and the market's crashing and all that sort of business. But it's just it's a bit of a topic at heart because it comes around every single property cycle and history repeating itself. But the silver lining for mine is that those that are or have been prepared, and if I just really look back at what we've been talking about for the last probably 2 years, a lot is about the finance environment, how it will change, how people's loans will roll off from interest only into P&I and be caught because they can't go anywhere else. Falling prices in Sydney or consolidating prices in Sydney, whatever you want to call it, and Melbourne for that matter, and not having cash buffers aside to take care of business when you need to, not having capital buffers to take care of business when you need to, or even to take advantage of an opportunity. Because let me tell you, there will be opportunities from this moment on for the next few years in different markets. And
if you're prepared for it.
You're prepared.
Yeah. So what we're chatting about here is that it's a market in flux, and we're talking primarily Eastern Seaboard, Sydney, Melbourne in particular.
Correct.
Right? That's where you see it in the softening. So it's a market in flux. Markets in flux offer opportunities, also offer a lot of threats and risk. And this is the nature of operating in that space. So to be a property investor who's looking to capitalise on a changing market, which is this podcast today, you're talking about preparation. Preparation being your house is in order, you got cash buffers, your interest rates are good, you're as tight as possible on your current portfolio and have an understanding and appreciation of this evolving market, and how you spend your money right now is going to influence your ability to get debt in the future. Right? You need to be
Correct.
you need to clean your act up, and it's not about, oh yes, Mr. Bank, I want to start borrowing more money, I'll change my spending habits now. They're going to look back retrospectively and have a look at you.
But it's preparation as well.
It's preparation. That's the preparation.
100%. Little things. Get rid of credit card debt. There's no greater return on your investment than clearing debt at 18 to 24%.
Yeah.
Like, it's a great ROI, right? Getting rid of personal loans, car loans. One of the brokers was telling me the other day that like, if you got a $50,000 car loan, it could be gauged as much as $200,000 mortgage debt or $200,000 worth of mortgage debt. That's
so that
big
hampers
hit.
serviceability.
100%, because you want to be in a position to be able to take advantage of the opportunities that present themselves. And let's also be clear that we are only talking about Sydney and Melbourne here. And yes, Perth is continuing on its downward trend for the most, even though it is arresting a little. Northern Territory is much of the same. Adelaide is steady as you go. We talked about Sydney softening, parts of Melbourne softening. Brisbane, steady as she goes. So it's not doom and gloom everywhere. But I think the media is doing a really good job with the levers
Beating it up.
that are being pulled to beat it up. And we don't mind that at the end of the day.
So the little things really matter. So you paid your car off in 4 years' time, you had no debt on it. Don't go out there and get a new one, because it's going to hamper your ability to invest in property. Little things like this.
Delayed gratification. How bad do you want it?
Yeah. And if you want to capitalise on market opportunities, you need to sacrifice. So the people that do well in this particular market cycle are those going to be able to make quick decisions based on the bedrock of confidence around their ability to secure financing and negotiate with. It's a buyer's market we're moving into.
But where?
In Sydney?
Yeah, in Sydney. Yeah.
Yep.
And I think, once again, that's my point. So it's a buyer's market in Sydney, or it's becoming. It's a buyer's market in certain parts of Melbourne, or it's becoming. As I said, I was up in Brisbane the other day, and let me tell you, it's not a buyer's market in the areas that we are.
Because it's full of buyers agents or buying property, right?
Buyers agents,
First home buyers.
first home buyers.
Those numbers are increasing. There's a lot more of them in the market now.
Interstate,
Like migrating
into Brisbane, because it's half the price of the average of Sydney at the end of the day, and it's a very attractive market from a dollars and cents point of view. Along with the cash flow, great lifestyle. It happens every cycle.
So ignore the media, is what you're saying?
I'm not saying ignore the media, and I'm not saying ignore the
I'm
data.
not saying you should read smartpropertyinvestment.com. We'll give you great information every day. Quick plug.
Only supplied by the good strategist.
The good strategist.
Yeah, but I think take the media with a grain of salt. Take the data as exactly that. It's just an indicator, and it's usually a little bit behind the times.
Yeah,
So,
it's rearward looking rather than forward.
well, it is. So it really pays dividends to, I'd love to say surround yourself with subject matter experts like ourselves. But if you're absolutely adamant that you want to do this yourself, and there's nothing wrong with that, then you need to invest the time yourself by going to the areas that you want to invest in, walk the streets in a good way, speak to the agents, and get some truth
So
around.
you've got to do the hard work.
You have to. You're spending $500,000.
Yeah,
You're not.
It's hard work.
You're not buying a pair of shoes.
More people spend time shopping around for the best deal for a hotel on the internet than what they do
So
spending
true.
$500,000 on an investment property.
So true. Yeah. But to be fair, for me to buy a computer, it'll take me 3 or 4 months, because just the nature of my
Because you're tight is the problem.
Well, yeah, because I'm tight, but I need to know that the widget that I'm getting is the right widget, and property's a little bit different, obviously, because I do it every day. But that's my point.
Yeah.
We do it every day, and if you want to be serious and you want to have your mitigation in place, then invest the time that you need to be the investor.
So on the research side, I can't remember where I saw or heard it. The property data looks backwards about what's happening. That might give you some indications on trends or interpretation of how things might move forward. But I think some of the rating agencies, whether Standard & Poor's or the other guys, have said this softening of Sydney property is not going to be as severe or as prolonged as recent cycles. There's been times in Sydney where prices have fallen rapidly over a period of time and bounced back up. But the numbers I saw was that it'll be a relatively sharp downward cycle in terms of time, not price, and then by the time it gets down there, it'll take about the same time to get back up to where it started. So it's not going to be as significant as previous cycles. But you got to get this information. You look anywhere, and you can disprove or prove a particular point.
Whatever you're looking for, you'll find it. And I read the same reports, and I just think that any of these forecasters, any of the economists, what have you, are really just that. They're just modelling something on certain trigger points and certain what ifs. Yeah. But nobody knows what's going to happen. So I'll guarantee you that all that modelling will be out the window if, let's just take finance once again, because that is the vehicle at the end of the day. If they loosen the shackles on finance, or if they tighten the shackles on finance even further, all of this modelling will be out the window, and there'll be a new set of modelling.
There'll be a new norm.
A new norm. And I mean, look what they've done the other day, which is something that we've also said that was going to happen, is Westpac pulling out of SMSF loans.
Yeah, St George,
And St George.
Yeah.
And we've been saying that strongly for the last 12 months. In fact, you and I have even had this conversation.
Yeah, we have.
So,
well, my broker actually emailed me during the week saying St George is pulling out. If you're not in by the 31st of July or whatever it was, you're not going to get it. And my response to him was, well, I actually got to find a place in an exchange before. And he went, no, they just got to get it in the system. They're going to wind it all up by October. And I went, oh, what about other lenders? What about Macquarie? Because they do SMSF lending. And he went, yeah, they can do it, but they don't have an offset. So, all these little nuances of it all. And I sat there and I was actually having a chat with a friend of mine who's a property investor last night. And we're looking at the logic of why they're pulling out of SMSF loans, because it's a good earner for them. Interest rates are significantly higher than what they are on owner-occupied or investor loans. So, our conclusion was that they probably don't want to get out of it because, it's good for business, but they're getting pressure from policymakers around it. And I thought, well, maybe they're getting, there's some good lobbyists in these super, retail funds or industry funds who want all that money going into their coffers rather than people managing them themselves. That's the cynical journo.
I was about to say, here's the doomsday prepper.
Yeah, but why are they getting out of the lending?
Look, I think, as I said, for 12 months we've been saying SMSF lending as we know it will not exist in the near future, and that's what's happened. But I think it's more along the lines of when they collate all the information and they see the debt to household income ratios and bits and pieces, and they've hit a bit of a panic button. Yeah. And here's another way to deleverage, I suppose.
Oh, look, it's bank policy. There'd be good rationale for it, but I want to try and get to the bottom of it. We might bring some people in and ask them those questions, but
it'd be good. But where does it take us to from here? And once again, I just urge people or the listeners to really look at the market in its entirety. We're talking about Sydney in terms of negative media. We're talking about Melbourne in terms of negative media. Let's not forget that interest rates and the cost of money is ever so cheap. Yeah. Like it is as cheap as we've ever seen.
It's a great environment to be in.
It's a fantastic environment. And we're just going back to normality. Those that can obtain finance at this point in time deserve to obtain finance at this point in time under the new, let's call it calculations.
Yeah. I've got no problem them measuring serviceability at 7.5% in P&I. I think it's good for investors.
It's pretty good mitigation.
Great mitigation. Yeah. Great mitigation, and knocking out 103% loans, come on. If you're taking on that sort of debt, you're a bit mad, right? Even at 90%, if you can get it in the 80s, I wouldn't be taking 90% mortgages in a market in a market in flux. It's a quick way to get into negative equity. And if you get that phone call saying, Mr. Tarrant, you got to, pay all this debt off. We don't want to hold this property no more because it's going up in value. That's when you find yourself a spot of bother.
Well, on that, I don't know of. I think I know of one person in 20 years of doing this. I know one person in residential environment that has been called in because of their equity position. Yeah. But I know plenty that have been called in because of their cash flow position.
Absolutely.
And this, for me, once again, this market that we're in offers opportunity. Now, I can understand that there might be some people out there listening saying, yeah, that's great. I understand you saying that because you're in the industry. But it's actually what I believe. Yeah. And that's where my money is. I'm still buying today. I signed contracts the other day on another property. Cool. I truly do believe what I am talking about. And I think you'll find most of the advisors out there that have seen multiple property cycles, and this is the key, multiple property cycles, would agree with me in saying that, it's not as bad as what it's made out to be. Yeah. And those advisors, those strategists that perhaps have seen nothing but the last 5 years.
Happy days in Sydney.
Yeah. Well, yeah, it'll be interesting to see where they are.
And this truly is a cash flow thing as well, because, to get called out on negative equity in a property, there's a lot of factors going to indicate that. Whether it's an off-the-plan apartment coming to settlement is a very different.
That's a different kettle of fish.
That's a point in time, but to actually prove negative equity in a property it's a lot of factors. But cash flow, cash flow is immediate, and a bank will call you out pretty quickly if they go, "You've missed an interest repayment."
They'll call you out within 30 days.
Absolutely, you missed 2 interest payments, you missed 3 interest payments. You're in trouble.
Then they'll look further.
Yeah.
Then they'll send valuers out, and then it's a whole different kettle of fish in terms of the equity position. So, which is why we are constantly reviewing clients' portfolios to make, and yours included, to make sure that the cash flow is where it is, that you're on top of your business, and that you can take advantage of opportunities or consolidate. Yeah. Sometimes consolidating and not buying anything is where you'll make your most money.
Yeah, and I've got no problem with that. So, if you don't have sophistication to make these decisions yourself, or you need some advice and guidance, be careful where you get your information from in property investment. Fortunate there's a good podcast around like this, but don't be listening to Uncle Benny at a family barbecue who's never invested in property before.
Uncle Benny.
Yeah. don't and be conscious about where you're getting your advice from. And whether or not there's any agenda behind that advice. So that's my 2 cents around this. But lean on people to help you make the right decisions. Steve, I think we've done pretty well out of this.
I think so.
Changing market in flux, get your house in order, look for opportunities, take the blinkers off, maybe emotionally or if you've got any perceived prejudices around the type of areas or properties you don't want to be buying, you're probably missing out on opportunities. I think we cover that quite well. Any other summation?
I think if you're yourself in a state of flux and you're unsure, reach out to the experts to perhaps cast an eye over your position. Yeah, is a really good start. And I think that you'll find the good experts, if they think that you're not in a position, they'll tell you so. Yeah, rather than, "Oh, no, you're in a great position."
You want bad, negative news from your strategist, your advisors, rather than always the good stuff. You don't want to pat on the back all the time and go, "You're doing well." You want them to challenge you
all the time.
You want to be challenged. That's what you're paying for. And a good strategist, a good accountant, a good broker will challenge you. They'll challenge your assumptions. They'll challenge your opinions. And that's what a good one will be doing. But anyway, normally I'd lean on Victor on this, but I'm going to have to come to you. If people want any information around Right Property Group, what do they do? Or they want questions around the podcast. I can't remember what the email address was. Is it questions?
This is a trick question, isn't it?
No. Questions.
It's questions at rightpropertygroup.com.au, or come to us via the multitude of different social
Facebook page,
social platforms, or jump on the website at the end of the day. And we hold open forums in Sydney on, I think it's roughly the first Tuesday of every month, have done for about 9 years now. Yep. And I think it's the last Tuesday or thereabouts of every month in Melbourne. Okay. Where we just get, we open up to the floor and we have a subject and we talk about that, or we have some guest speakers and we sort of turn everything up on its upside down. That's and on its head.
And I've been a couple of these myself, and they're very similar to this podcast, right? Just people talking property, Yeah. It's an open forum, Yeah, very much. Get a lot of info out of it. And what I find interesting when I come to yours, which is probably a bit too infrequent, so I'll make a bit more of an effort. But you got punters in there, and that's a term of endearment of have been to your forums for maybe 4 years and never bought something, but they go every single week. But then you got people with portfolios 50 and they're still going along and they get a lot of value out of it. So it really intrigues me.
We like it.
The diversity.
Yeah, we like it because even if someone comes for 4 years and doesn't utilise our services, we're cool with that. We don't mind. As long as we can perhaps educate, and everyone uses that word, I suppose, but if we can open people's eyes and inform, it's a chance for people to network with people that are thinking about starting or that have got the 50 or whatever it may be. So it's a great learning platform as well off the stage. But it's not we call it a safe space. There's no selling from anyone. And if we find anyone sort of swapping business cards and trying to sell, I don't know, Amway or Nutrimedics or off the plan, they're out.
So the
nothing against Amway on
no, Amway's great. To my point around, there's no excuse not to be educated in property investment. So if you want to do the hard work and you want to be successful, you got to do this sort of stuff. Anyway, thanks, Steve. Really enjoyed it. Victor, shout out. We'll see you back next time. And I'm going to challenge Victor to come along with a really good topic. I like the idea that we're very fluid in the way we set the agenda for these particular podcasts. So we're right on mark in terms of what's happening current with the status here and now. So Victor, come together with a really good topic, and I'm sure we'll have a good chat. We'll be back again next time. Until then, bye-bye.